All right. Today's topic is going to be a little bit different. I think it's one of the most critical topics in trading because it addresses the key problem. All right. Now, here's the issue. You see a lot of traders that are trying to trade, but they just can't. They know it's possible. They see it in hindsight. They can do it, but they just can't get over the hump. Now, so what they'll do is what you'll see is a lot of like analysis. For example, in Wyckoff, you see a lot of traders. What they'll do is they'll take a chart in hindsight and then apply the schematics and say, oh, this was the climax, secondary test, up thrust after distribution, and they're following that pattern of distribution according to a schematic. So that is not going to help you at all. You'll have other traders that will take a look at, for example, what they'll do is they'll take a look at this on a chart and in hindsight say, yeah, the opportunity to buy was right here. And, I would have done a measured move and got out around here. And my stop would have been here, right? So this type of hindsight. So the point here is that they know it's possible. They know trading is possible and the riches are there, but the execution isn't. The analysis is there, but the execution isn't. And how to do the execution, if you ask, if you get this answer, you know that there's something really wrong. If they say, oh, my target is this, my stop is this, so I'm risking this. So this is their understanding of execution. Stop, target, and the risk. This is the oversimplification of execution that's in their mind. To say, okay, this is stop, this is the target, this is the risk, this is a 3-to-1 or 2-to-1, whatever. Right? So that oversimplification is not enough to execute correctly. All right. So you'll see a lot, because of this, there's a massive gap between analysis and execution. If you go on YouTube and you get all this stock shit, right, you'll see a lot of folks from different companies doing market reviews about, the sectors, right? Okay, the sector, this is a leading sector, their top 5 stocks, these are the leading stocks. And these are the industries and all of that. And then these are the analysts that's on YouTube. And then you have some things like even in Wyckoff, they'll say, oh, okay, in 19 blah, 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 this is what the market did. And today it's doing this. And you see the, whatever, the comparison and blah, blah, blah. This is totally useless. Or they'll say, okay, look at a point figure chart. And, 5 or 8 years ago, it had a base and it projected a target, and we are there now. 5 years later, or whatever, 7 years later. Some of them do it like over 10, 14 years later. This is useless. This is useless because nobody made the dime. It's just coincidence and it's cherry picking. All right. So what I'm trying to clearly explain is that there is analysis and there's trading execution. And from looking at charts that it's 100% possible. It's there, you're almost there, but it seems forever out of reach. Or as soon as you try, the market humbles you. So you're stuck right there. You're stuck in this hole, this analysis hole. And this is what you'll see with many Wyckoff traders, many traders, all those guys on YouTube that do, all the fancy analysis and have these charts about rotation and sectors and the indexes and comparing this to like this market 10 years ago and all of that. This is totally useless. What it is too much focus on analysis, and it's really analysis paralysis. You're stuck in that box. but he cannot get to the point of execution. All right, now there's a term for this that was identified by Douglas, Mark Douglas. He called this psychological distance. This thing right here, to get from analysis to execution, he called this psychological distance. All right, so the psychological distance, it really, you gotta bridge this. All right, now I've decided that I'm going to explain how to do this. You're not going to find this on YouTube, by the way. I don't think so. But because first of all, it's not something, I don't know, it's not, maybe the focus isn't there or something. I'm not really sure, but this is like, I'll explain how to get across the hump, all right? So I'll just explain how to get across the hump, but it takes people out of their comfort zone because there's risk and there's fear associated with it. As soon as, because many traders try to do this, they go from analysis to execution and they get burned. And that burn, that loss, the loss of an account once or twice, it creates such a psychological impediment that it's like your mind doesn't want you to trade. Or if you do trade, you fuck it up. All right. So, and that usually happens because immediately what happens is when traders start trading, it's not hard for them to start trading. For some reason, they'll just jump right into trading. Then they'll get burned really bad. That pain associated with losing an account or losing a large sum of money, understanding that you were quote unquote wrong, that it was your fault, that you didn't prepare, that you might think you're stupid, that how could you do something like this, that guilt, all of that together really creates the perfect storm that ensures that you're stuck in this box of and never go back there because of psychological distance, etc., etc. Anyway, so I'm gonna, there's a lot of folks that are stuck here. They need to get to execution, so I'll explain what it is. In order to do that, you gotta get away from, okay, this is my stop, this is my target, this is blah blah blah. It's an oversimplification, but I will explain how to deal with this. All right, now here it goes. First, you have to understand that trading execution has stages. There are stages in the execution. It's not just stop, target, risk. Okay, if it works, it works. Wait, There are stages. You need to understand those stages. You need to understand what stage you are in and what to do in that stage, the expectations associated with it, and that's it. And then what you do is you refine each of the stages. So trading execution has stages. You need to have awareness in each of those stages, along with self-awareness, by the way, so you don't make any errors that'll, cause you to lose money, but that's a different story. So I'm going to explain those stages, and the only way you can improve in those stages is by trading. You cannot be a good trader without trading, by reading books, by reading Wyckoff courses and all of that. That I'm assuming you've already done, or whatever it is that you're doing, you've already done that part. So it has to be experienced, and the analogy that is best, I think, would be a sports analogy. You can't play basketball by reading a book about basketball, just like you can't become a swimmer by reading a book about swimming. You cannot be a baseball player by reading a book about baseball. It must be practiced. It must be put into effect. Now, for futures trading, Yeah, you can do it in a sim environment, but right now you have micros, which is the perfect training environment because of the psychological risk is so low that it's already accepted, meaning the loss is already accepted. Why? Because the same amount of money you spend every day, so that amount of loss is already accepted, meaning, you spend, if you take a look at how much you might spend outside on lunch and dinner or with coffee, there's probably the same amount as a loss within a micro. So the psychological effect of that is that you can use it as a training ground because it's already within your acceptance of how much you're willing to spend every day. Even though, if you keep spend on stuff that's more expensive than what you need, it goes to quote unquote waste, but it's within that acceptance that you automatically programmed, like your psychology already accepts. Like if you accept to spend in Starbucks 2 or 3 times a day, plus I don't know, lunch, then whatever you do on the weekend, all of that will make the acceptance easy, and that creates the training ground. But besides that, it provides the training ground for learning to train, just like a swimmer needs to swim in order to become a swimmer, just like a ball player needs to play ball in order to become a ball player. All right. So what are the stages? Now must be understood. Number one, it is edge. All right, that's the first one. And what I mean by that is ID the edge. So now you're not in the trade. You're basically, all you're going to do is ID the edge. All right. So you're not in the trade. Now, that's stage one. So maybe I'll use an example of one of the easiest edges would be the test of the breakout. Right? I mean, they have breakout and it's test of the breakout. Wyckoff traders call it jump over the creek, or was it test of ice? I think it was. It's basically a test of the breakout or the breakdown, right? So breakout or breakdown. Okay, we'll just use that example. So ID the edge, basically you have a test of the breakout. That we'll just say that. It makes it very simple. And also this is an actual very good edge because it works. Test of the breakout on a higher time frame and entry on the lower time frame. So this is some will make this more elaborate by looking for a upthrust on the test of a breakdown or a spring on the test of a breakout. You can do that too. All right. And then the next thing is, so these are all stages, and you have to know where you are in the stage. So right now you're on ground zero, just looking for an edge. You're only looking for a test of a breakout, or you're looking for a test of a breakdown. After that, you look for the signal. All right. Now, what I mean by the signal is the right to consider this a trade. All right. Now, whatever signal you use, some will look for a change of behavior. Some will look for volume off the bottom. Some will look for diversions. Some will look for a trend change, so whatever, the signal. So just to keep it very simple for everybody, we'll just use change of behavior, or, Koch, with a change of character and change of behavior, same shit. All right. So remember, you have to know, I'm not just writing this down, you have to know where you are in these stages. You have to know where you are in these stages and what to do. And there's a wait time. There is a wait time with each stage. You're waiting for the edge to appear. Then when the market goes to test the breakout, you're waiting for the change of behavior. All right, number 3 is that the trigger. All right, so for many folks, they will do something like, okay, there's a LP, a lack of supply or lack of demand, which is nothing more than a low volume pullback. So let's just call it a low volume pullback, okay, plus a reversal bar. So what that means is you have basically a change of behavior, you have a pullback, little wave down, low volume, maybe 1/3 or less than 1/3 of the change of behavior on a pullback, and then a reversal bar right after the low volume pullback. So that trigger, okay? Now again, you have to know which stage you're in. Your first stage, you're looking for that edge. Second stage, oh, okay, when it goes to that edge on the tested breakout, you have change of behavior. Now there's a wait time between this, and then on the pullback after the change of behavior, which has its own wait time, you're looking for a reversal bar, all right? Then that's your trigger to go long. So then you have the fill. So how you do this is you might just buy the close of the bar at market, or you might put a limit entry, right? Like right after the close of the bar, you wanted to pull back maybe halfway, mid-bar, and then get in. So let's say you have a reversal bar, you have a green bar, and for some people, they'll be looking for engulfing or pin bars or whatever it is, and or just a green bar, right? And then they'll get in halfway of that green bar. If the range of that green bar is 10 cents, they'll get in at the 5-cent mark with a limit entry. Then you have to identify your break-even point. So this is when you move your trade, your stop to break even. When do you do that? You move your stop to the break even, let's say after it takes out, after you're filled and the trade starts working, and after a higher high. In the case of a long, you add a reversal bar, you wait, it takes out the change of behavior high, the high of the change of behavior. When it does that, you move your stop to break even, so now you can't really lose money. Then the target. Okay, I cannot tell you how many times the trade has been totally screwed up because it went to 90% of the target and then fucking fell back down. And if you don't know how to do that, how to exit, right? How to have a target, but if that target is not reached, and maybe only 80 to 90% of that target of a pretty big trade is reached and reverses, how do you know to get out? It's a major issue. And this really is, there's a lot of psychological factors. One, by the way, is hope. Two is if you have a prior loss that you're trying to make up for and you're carrying that baggage with you. So there's a lot of stuff that goes on behind, mentally, right? And you have to disconnect from that and focus on just proper execution. But anyway, the target, which includes the target and where to get out. So a lot of folks will just use a new high. As soon as it makes a new high, or like right at resistance, or they'll just use a trail. Others will use volume profile strategies and they look for some point of control area to exit. So to keep it simple, we'll just call it a higher high. As soon as it makes a higher high, get out, right? But what if it doesn't, right? What if it doesn't? Higher high plus, at this time, you will continue moving the stop below prior swing lows. Right? Now, what does it mean to swing lows? You can't, okay, first of all, market does this, right? Can you say this is a swing low? This is a swing low? Or this is a swing low? At this point, this is totally incorrect. Only after the high is made, and by a high, I'll explain because there's a lot of errors people make. This is where the stop goes. After the high. Now here's the thing. This is like a little refinement. If you have this situation, right, where it makes a higher high, but the low of the bar is overlapping, meaning you have a bar here, right? You have a, I'm just draw a bar. You have a bar here, right? But its low is overlapping the prior swing high, right? It's possible that this is an upthrust and it has not enough follow through to consider it, in my opinion, clean break of the higher high. In order to cleanly break the prior high, the low of the bar has to be above the prior high. Is a key distinction to say that it is trading completely within a new range. If you do not look for that, it is very possible that this thing is going to spring, it's going to come right back down. This is a very important refinement when doing stops, because the low is within the prior high, it's overlapping the prior high, it hasn't completely left the range. Even though the high is above the prior high and the close is above the prior high, the low is overlapping the prior range, which means it can reverse and take out. I mean, that's just a very fine distinction. And anyway, so you have to know how to put the stops. You have to know how to put the stops. One other method is, by the way, you only put the stops after it makes a spring and then goes up, and then you put the stop. This method is like stops below springs and stops above upthrusts, because they're harder to take out. They're harder to take out. I mean, the market will come back like this, and they'll take out this high, the prior high, but they won't take out the spring, and then it'll go up. So this is also excellent method. All right, and then it'll do this, right? And it might do a double bottom. So do not put it right there. Do not put it right there. Okay, you have to put a little bit of distance, because as you know, markets, they will target. And this happens usually when the highs, a higher high is made, right? But it's not completely taking it out, meaning the low of the bar is not above the prior high. If it's not above the prior high, believe me, they're going to screw you right here, because they make the high, but doesn't completely leave the range, and the follow through is poor in order to probe the market. When they probe the market, it gives them an idea of how many orders are there. And once they probe the market, it proves that they can go higher and that the buyer is there. Once they have that proof, what do? Rip below in order to accumulate. And in order for them to buy, they have to run the stop, which means you have to sell. And then go higher. All right, this is the thing. This here is actually a probe. And once they see, oh, the order's there, but there's still not enough liquidity, what they'll do is they'll run it down. They run it down, get the accumulation in a quick way by doing a stop run, and then take it higher. So anyway, these are refinements. I can't really go into all of them. It'll give me a headache. But the stages here is what I wanted to focus on, which is ID the edge. You have to see yourself in each one of these stages. Okay, you have to see yourself in each one of these stages in order to bridge that psychological distance. You have to know the stages of execution, and you have to know what to do within each stage. So now the next steps, what you can do is you write each one of these in your trading plan. By the way, if you have 2 targets, stage 6 would be for target 1, and then you have to have for target 2. For each stage, right, you have to do a description of the stage. You describe the stage and the wait time, what you will do during the wait time, and how you will behave, like what to do. All right, so I'll give you an example. Once you are filled, or let's say once you're filled and the trade starts working break even, right? Okay, so we're at the break even. We moved the stop to break even, and now we're waiting for the target to be reached. Here's what not to do. Do not look at the chart like a hawk for 3, 4, 5 hours. You'll go insane. So once you have a zero risk trade, which means it's moved in your favor and you're waiting for the target, one approach you can do is you use a stopwatch, not a real stopwatch, but just go to your browser and look up Google stopwatch. And then you monitor the chart every 30 minutes. Given that you're trading on, say, a 5-minute chart, right? Because you're already a break even, and now you're waiting for the target to be reached. And I'm assuming you have a 3-hour plus target. I have, even more than that. And you want it, it's not going to take 5 minutes, obviously. It's going to take hours. So in that, it could take 1 hour, it could take 2, 3 hours, it could take half the day. It happens all the time. It could hit it next day. Let's say if you get in the trade end of day during the short covering, you get in, it could hit the target overnight or the next morning. So in that situation, you just walk away. But let's say it's during the day, what you don't want to do is become a bird and look at the chart. It's not going to, you just waste your life. So what you want to do when you're in this stage, what to do, let's say when you're at break even, right? So what happened? The market made a new high. And now what you need to do is you're going to be waiting. It could be an hour, it could be much more than that. So at that point, what do? Use a stopwatch. Use stopwatch to monitor every 30-minute. Okay. You may even want to put if you have your break even and target in, you may even want to put the platform down, or put the chart down, right? Or you can just use a stopwatch to monitor every 30-minute. You want to get it away. You want to get away from it, okay? All right, and you want to use and put a trend line alert at target and stop. Okay, so the market makes a new high. Use stopwatch to monitor every 30-minute and put a trend line alert at the target level and stop level, and put minimize the chart, and then every 30 minute you monitor it. Let me see, before every 30 minute, if you see a swing low, move your stop at swing low. And you see, if you see a swing low, and remember, swing low happens after a swing high is made, and that swing high totally takes out the prior high, because the low of the highest bar there in that swing high is above the prior high. There is no overlap. It is not an upthrust position. There is good follow through. All right. So this is what I mean when I say how you handle the situation. You describe it by saying the market made a new high, so you are at your break even. You've moved. Move your stop to break even. All right. Now put away your chart. Minimize the chart and use a stopwatch to monitor the position every 30 minutes to see if there was a swing high made. If there was a swing high made, move your stop under the prior swing low. And did I say minimize the chart? I think I said minimize the chart. Minimize the chart, and then final thing, put a trend line alert on your target and your wherever your break even or stop is. Put a trend line alert so it alerts you that yeah, you hit the target. In this way, you will not be like a bird looking at the chart for 3, 4, 5 hours. Even intraday trades on a 5-minute chart, it can take till the end of the day to hit the target, or easily midday. It definitely usually takes more than an hour. So, looking at the tick, 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 up, down, it's insane. All right. So you see how I'm taking the break even? I'm saying market made a high, I move it to break even. Now I'll put in a trend line alert at the break even and the target. I'll monitor every 30 minutes and minimize the chart. And every 30 minutes, I look to see if the swing high is made, and I just move my stop below the prior swing low until I get stopped out or it hits my target, right? Also, so similarly, you do this for each one of these stages, and you see this is what you need to do, because you always need to know what to do and what to do next. You should never be in a state of I don't know and I have to figure it out when you're in a trade. Everything that you need to do and you need to do next needs to be known. This what I'm explaining, right, has to be practiced. It's not as simple as reading this. It has to be practiced, because some people, they cannot stop looking at the chart. They just can't do it, or they cannot put the placement of the stop or the target correctly. And many times you will see that even in a successful trade, they'll mess it up. So that has to be practiced. It's easier said than done, so you have to do it. And now it's possible to do it because of micros, which have a very small risk, which is in the psychological acceptance of what most traders can already afford to risk. All right. Like on, I don't know, it's like $1.25 a tick or something like that. But you can do that now. So again, these are the stages, and you work within each stage by describing and what to describe it and what to do in each stage, and then and then practice this, just like a swimmer needs to swim to learn, a ball player needs to play ball to learn. You practice what you said you were going to do, and you refine and refine and refine in a low risk environment like the micros. And you know what is going to happen? After you do 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 20, 30, 40, 50, you will reach a point where this magical thing happens. And this is how it happens, by the way. Trading becomes effortless. That's what happens. Trading becomes effortless, and all the crazy shit that's going on right now goes away. All right, because you know what to do, you know what to do next, have the execution completely down, and you've already done it 50 times, 60 times, 70 times. You already done it. All those scenarios, you've already done it. You've stopped out, you hit the target, you've gone to break even, you put away the charts, and you're not watching it like a hawk, and you're not getting stressed out. So this is when trading becomes effortless. And this, by the way, is what Douglas was talking about when he talked about the psychological distance that is required to get from point A, which is typically the analysis paralysis stage, to point B, which is the ability to execute. This is how you do it. All right, that's all, folks. Hope this helps. Thanks. Bye.